Liquidity is not very deep in this market, so we don't invest basically in domestic China at this stage in our portfolios. We're still looking at the H-share market, and it was a tough year for Asia overall. There's Japan, that was probably the only market that was really up, and all the other markets are flat or slightly down. We expect the Fed to move finally in December. It's about time, and we think once the market is looking back and sees things are not as bad as probably thought, we actually think that Asia has more potential on the upside. I think one of the big drag was, of course, the strong US dollar, and that's usually not going well down with EM overall, but also with Asia. But also the US dollar strength, we expect it to fizzle out over the year, next year. The market is probably too much positioned on rate hikes in the Fed, and all the other markets are on easing mode. And as I said, this trend will remain, but a lot has been priced in. And over the time, it will be clear that in Europe, things are moving better. In China, things are stabilizing. And that basically should give a bit of a sentiment boost. And valuation is cheap.
Cooling down, slowing down, there's no question asked. And I will see this is a long-term trend. Even though the PBOC keep on cut the interest rate, cut the triple R, it doesn't help a lot. Yeah, because the consumer, the habits is changing. Especially when I would take a walk on Canton Road, I don't see the tourists anymore. I don't see the crowds on the street anymore.